Welcome to Boxes and Lines, a different kind of finance podcast from a different kind of stock exchange, featuring IEX founder Ronan Ryan and Chief Market Policy Officer John Ramsey. Now here to give you the straight talk on how the markets really work, it's Ronan and JR.
Welcome everybody to the latest episode of Boxes and Lines.
Boxes and Lines, welcome. It's been a long time.
Was that your Halloween start?
I don't know. I don't know what's going on. I'm just very excited.
Okay.
Well, it's been a long time.
He's very happy. We've got a great show lined up for you today. Joining us for the first time on the podcast is Mike Seigne. Michael's a seasoned expert in the world of finance, particularly in the realms of equity execution and market structure, and he's a friend of IEX, and I'll tell you why.
I just learned is originally from the old sod from Ireland.
We're going to let you speak in a minute,
correct?
Mike.
Yes.
He looks like he's about to violently jump through the screen as we say this. But I have a great relationship with Mike, and I figure I'll give a little bit of background to the listeners. He's over 30 years in the biz, working as a managing director at Goldman Sachs, as head of sales and co-head of European electronic trading at Virtu, and as global head of execution services at Redburn. He is now the founder of Candor Partners Limited, which is focused on making things fairer and clearer in the market for publicly listed companies. Fairer.
Well, we love that because we are also about making things fairer.
I wonder if he got that from us. Anyway.
Maybe. Well, I'm sure he didn't. He didn't.
Let me intro Mike a little more. His work always finds its way into academic research, specifically when it comes to market anomalies and the weird stuff that happens with stock prices and the intricacies of share buyback. We're happy to have him here. Oh, Mike, sorry for that. And thank you for joining us and not hanging up immediately after you've heard JR's shite Irish accent. Mm-hmm. But welcome to the podcast.
Thank you very much. And take it easy on me. First time doing a podcast.
Yeah, don't worry. We'll be very nice to you. Do you want to ask the first question, John?
Oh, you want me to ask?
I wasn't prepped for that.
Well, that's fine. No, I can do it.
Well, I know Mike very well. So Mike and I have traveled around Europe while I have been at IEX and while Mike was actually at Goldman, Virtu, and Redburn. And we've met many of the buy side in London, Edinburgh, Paris, Frankfurt, Stockholm, Amsterdam. Wow. Jesus, we did a lot, Mike.
That's
I even did an
very
IEX.
impressive.
I seem to remember.
Oh, and the last day of one of the weeks, I was so knackered, he did the pitch where he got up and drew the IEX model while being paid by Goldman. I swear on my life. It was actually pretty classic.
You then stitched me up with the last bloody question. You asked me how come the speed bump was 350
Oh, yeah. I actually heckled him. What an asshole.
But, well, there you go.
I think you knew the answer.
No, I found out it was twice the speed of the the backup latency or something weird like that. I can't remember. But
yeah, it was a little longer than our longest backup route to NYSE, which was 338 microseconds.
That shows how ignorant I am. I didn't know that.
Okay, ignorant man. Do you think you can read a question?
Yes, I can. So Mike, you have written extensively about share buybacks in recent years. I know I've talked to you about this topic too. So I know that you know probably more than almost anybody else about that. Can you explain how the process of share buybacks typically works, and maybe a little bit about, for the uninitiated, just the inefficiencies and problems that you see in the way that buybacks are done today?
Yeah, and I would couch that, Mike, that we have some very intelligent listeners that listen in on this podcast, but they don't always know the industry jargon. So if you could...
Right. There's about 6 questions in there.
Yep.
We'll
be back in about 10 minutes.
We're going to get a beer.
I kissed Blarney Stone a few too many times. I grew up about 15 miles from it. So,
see, he's actually Irish, John, not like you.
Let the man speak.
Yeah, I'm called a plastic paddy in Ireland because I feel very Irish, having grown up in Ireland, but my accent would be anything but. So the Irish don't think I'm Irish. So.
Yeah, I thought he was English when I first met him, but then he assured me.
Yeah,
you're okay, Mike.
Right. So share buybacks are very straightforward insofar as, companies are just buying back their own shares. So from the perspective of it's a very much an everyday behavior, but obviously it's wrapped up in a little bit more regulation from the perspective of, there's a different set of rules. I should probably tell you how I sort of started to look at it, because I've spent my whole career on the sell side, dealing with the public side of execution. So, my client base historically has been everything from asset managers to brokers to retail aggregators, that sort of side of things, hedge funds, that stuff. And I've never dealt directly with a corporate. and never sort of interacted on share buybacks before I started on this journey. But I was working for a company, and we sold ourselves. The last firm I worked at, we sold ourselves to a bank, and the bank sort of asked me if I could help them build. Their bankers were asking me if I could help them build pitch books so that the bank could sell, the broker's execution service, like the continuous market execution service, to their corporate clients. When we got on to talking about share buybacks very quickly, and to cut to the chase, I sort of said, look, why don't we have a look at a few pitch books that other investment banks use to sell share buyback products to, and then we can sort of build something from there. And what I saw was completely different to what I expected to see in terms of the execution products which were sold. So I was expecting the normal, what I would call normal execution strategies, to do with, how do you navigate buying a large value of shares in a market versus trying to minimize the impact you have when you're doing it. And the solutions I saw were very different to that. So, that's how I ended up sort of starting and sort of exploring this process. And what I saw, I didn't like. The questions I was asking were things like, how can we not provide the similar types of execution service and products, and also access to liquidity that we do to our institutional shareholders? How come we can't provide that to corporates? So I don't know if I've asked your question, but
I mean, as I understand it, from what I hear you're saying, that with the way, at least according to your perception, the large firms that were providing buyback services, so far as you could tell, were not doing so in a way that was calculated to really maximize the benefits to the corporate client. I assume the contra to that is, in some sense, maximize the benefit to the service provider or the bank that was providing the services, but to the detriment of the client.
I mean, I'm all for service providers maximizing their own margin, but it's got to be conditional on providing an excellent service. And if you think about what you're trying to do, if you're a corporate, you're trying to buy back your own shares. I think you should think about it in exactly the same manner as if you're an investor trying to buy a stake in a company. It's exactly the same problem. We should solve it in the same way. There are different parameters that you need to deal with because of the market abuse regulations and all those sorts of things. But the problem's the same problem, so you should address it in the same way.
And I take it that, I mean, maybe there's other problems or issues, but I take it that one of the problems or concerns in executing any kind of algorithmic trading strategy is you want to avoid signaling, right? Or you want to avoid activities that notify other people in the market what you're about and where the price is likely to go, and allow them to exploit that information in ways that hurt your objectives.
I think it's a little more basic than that, though, right? So when Mike was on the sell side and talking to big institutional investors, and if a big institutional investor wanted to buy, let's making numbers up, $50 million notional of company ABC, they would go to a broker and they would get a very different service than if the company ABC goes, hey, I want to buy back 50 million notional of mine, right? And the original idea, because we have similar rules over here, Mike. I mean, I don't know if that's in our questions here, but I'd be curious the difference between the US and Europe. But of course, there are protections in place so ABC doesn't inefficiently buy $50 million notional of their stock and cause the stock price to jump up. Like, there's rules around that. But then I think, what we've talked about and what you've looked into is, as a result, maybe the corporates, the ABCs of the world, are slightly taking advantage in how people handle their orders.
Yeah, correct. I mean, there's a whole
See,
series
John?
of
See? Fuck's sake.
I understood the point.
Yeah, I don't know. He went on a rambling road.
Let him speak.
Mike, I apologize for John.
Please, let him speak.
So the market abuse rules for share buybacks vary by the different jurisdictions, but they're essentially the same thing. Through my mind, there's actually no need for having specific, market abuse rules for corporates themselves. The way they're structured is they're structured for the safe harbors, both in Europe, the UK, and also in the US. And so long as you stay within very, very specific set of parameters, which essentially try and control for three things, really. One is, what percentage of volume are you? The second bit is when during the day are you trading? That varies quite a lot. But in the US, you can't trade in the open and the auctions, the opening auction and the closing auction. And then the last one is a rule which is to try and stop you from driving the share price higher.
Right.
So what I call the plus tick rule, from the perspective of if you short sell in the US, you can only short sell on a plus tick. If you're doing a share buyback, you can't create the plus tick.
Correct.
So they're very sensible rules, but every other investor and every broker has to stay within a very, very similar set of rules, but they're just less defined. So you can't manipulate the market as the general rules we all have to abide by. There's a subset specific for share buybacks. Now, you don't have to stay inside them if you're a company doing your share buyback. It just means if you do stay inside them, you're protected from any, as you guys would call it, any litigation.
Right. And and certainly in the US, everybody just sort of tries their best to stay within the safe harbor because it's really a safe harbor from the anti-manipulation provisions, and nobody wants to come anywhere close to being accused of. But you're right, Mike. I mean, in the US, that the driving purpose behind these rules was really around the concern that companies, because companies, all things equal, prefer that their stock price be higher rather than lower, would use these kind of programs in order to push prices higher. Yeah. And so trying to guard against that. Yeah.
But the sort of specific issues that I'm calling out within the subset of products which are sold to corporates, there's some parts of it which are absolutely fantastic for corporates, and I think generally for the market. And that's the products basically abstract away all of these problems from the corporate in terms of staying within the safe harbor rules and all those things, and also allows the corporate to trade in what's called a quiet period. So as soon as after the company has published its numbers, you've got a very small window where the corporate can do transactions in their own shares before they sort of fall back into a quiet period again. And these products allow the corporates to trade within the quiet period, so they can basically continuously trade, which is great. So all that stuff is fine. But what the problem is that embedded within these products is an underlying execution strategy, which doesn't align with the requirements of the company, but specifically their board, in terms of the governance responsibilities they have to their shareholders. Because if you're trying to buy you're going to take, say, $1 billion of your capital and you're going to allocate that to doing a share buyback, the board has a responsibility to make sure that that's done responsibly from all shareholders, all stakeholders' perspective. Sure. From this perspective, all shareholders' perspective. And the underlying goal of that is to buy as many shares as you can. I mean, all else being equal. Yep. And obviously, cap or constrain the cost of doing that. And the products that I'm calling out, they don't set out, their ambition or their design is not in line with what everybody else in the market uses from the perspective of and very well-founded execution strategy. They're well-founded in academic research and also an enormous amount of good practice. They don't use that same product. So if you look at the actual benchmark where the broker is benchmarked against and also remunerated against, because if they outperform this benchmark, their fee structure is geared off the more you outperform, the more money they make one way or another. Mm-hmm. Those two things, they don't align with what the board's responsibility is to try and protect their shareholders. So that's where the issue is. So there's four main concerns, but that's number one is sort of the governance problem for the boards, and pretty much all the boards, they are completely unaware of this problem because there's no transparency or very limited transparency for shareholders and for the market to be able to see the structures and the behaviors of these programs, particularly in the US. Right. So it takes somebody who has been across the wall, if you like, and seen what the structures look like to go, and you've got to be someone who's experienced in execution. So when I take these products and I explain them to the normal institutional buy side, they're horrified because they're like, what? This is so they can immediately see the problem.
So in some sense, the problem is about basic misalignment of incentives, or at least that's a big part of the
completely
problem.
Misalignment of incentives.
Yeah,
it's exactly that.
And one other question I have about buybacks, and then I'll pass it back to Ronan, so he doesn't feel left out.
I'm going to fucking remove this part anyway.
Is that it's been several years, but there was a long period of time where corporate buybacks were big hot political issue in the U.S., as I'm sure you're aware. And so, a lot of concern about companies spending too much of their own capital in buying up shares. Suggestion that in many cases really for the benefit of corporate insiders rather than for other folks. And that seems to have died down some. And there was also concern that much of during sort of the big bull market period, that too much of the upward movement in overall market prices was driven by that activity and dependent on it. Is that still, from your perspective, it feels like some of that chatter has fallen away? Are those kinds of concerns as present in the U.S. and the U.K. and how do you think about those issues today?
I mean, I'm an execution guy, so I'm not a corporate finance or a banking guy, but yeah. I know what you're talking about. I've read a lot about it, and it's really interesting when you read articles in the press. There's been quite a lot of articles in various different parts of the press, and particularly like the FT and the Sunday Times and the Wall Street Journal. Quite often you could read the comment section below.
Just go straight there.
How much sort of, how divisive share buybacks are. But I don't think, certainly through my lens, it doesn't appear to be too much of a problem from the perspective of, so long as the governance within the organizations understand those dynamics. And I think they really, really understand those dynamics. That problem behind the scenes, I think, is very well handled from my sort of outside looking in process. But the reason I think it is so divisive is because when you think about, from a corporate finance perspective, why do companies do share buybacks, and sort of like what actions can they take which involve share buybacks? If you're doing a share buyback because you think your stock price is really, really cheap, it's like a form of, you're allocating some capital back to buying your own shares as a form of investment. It's a very different type of transaction to one if you're trying to change the structure of your balance sheet, right? So if you buy back shares and if you issue debt and buy back shares, you can leverage your company up more. And that's very different to one where if you've got excess capital and you're just trying to return it to shareholders, and instead of paying more dividend, you might return it through doing a share buyback. All three of them are very, very different rationales, as the SEC would call them. But what you can't escape from is the whole thing is one ecosystem. So if you're doing a share buyback to return excess capital, you're still buying shares, and that's still, the share price matters. It's still an investment. And hidden in all of this process is, Warren Buffett explains it very well, but the price at which the shares are bought back at is really, really important relative to the intrinsic value of the company. So if the share price is way above, the fair value or the intrinsic value, the business value, what's happening is wealth is transferring from the long-term shareholder to the selling shareholder. And obviously the governance process needs to make sure that doesn't happen, because the board, the purpose is to try and create long-term shareholder value, right? So you can't do that.
That's very clear. Did you understand that?
Completely.
Okay.
I learned that. I always read the comments at the end first. I barely ever read the fucking article. Now, I have a question, Mike, based on something you said earlier, and maybe I misinterpreted, but let me ask the question as it, with regards to fees. So what these public companies pay the brokers in order to execute these things. It sounds like you're saying they're shelling out more than they probably should be to buy back their shares. And what are your thoughts on what the industry or regulators should be doing differently to sort these issues out? A long question. Were you saying before, when they buy back their shares, the brokers have to adhere to like a benchmark? Like, I think it's in the US, it's like VWAP. Are you saying that depending on how the broker performs relative to VWAP, they can charge the public company more? Did I make that up?
You didn't make that up.
Okay. I thought I heard you say it. I had never heard that before.
There was about 8 questions in.
Yeah, so that's how we roll on Boxes and Lines.
Yeah,
we're very
you can
dynamic.
answer any of them.
Yes.
I mean, we give you,
You can just tell me why the circuit to Mawa is 350 microseconds.
So the last question was about the benchmark. Like, there isn't any there isn't any requirement for anybody to achieve a benchmark. But the way quite a lot of these products are structured is that if the broker outperforms that, what I call the bogus benchmark, but it's an execution benchmark, then the broker gets to charge the fee structure is okay. The broker might say, okay, well, I will guarantee you, the corporate, a 1% outperformance to that benchmark. Anything beyond that, I keep as a broker, or anything beyond that, we get a 50-50 share. So they're incentivized to A, beat the benchmark, and B, the more they beat it, the greater their fee is. So in principle, I've got absolutely no problem with that, in terms of, that's a great way to align the interests of the corporate and the broker. But it has to be conditional on that benchmark needs to actually reflect what's good for their underlying shareholders and the corporate themselves. The problem is it's not. So the reason, and I said I don't want to get into the details of the actual benchmark itself, but it's not what you and I would know as VWAP. VWAP stands for volume weighted average price. It's not that. It's called that. And I thought it was that. You obviously thought it was that too.
Yeah, me too.
It's not what institutional people know as VWAP. It's something very, very different. It's a TWAP with a wobbly end time, which if you think about that, makes it very, very easy to beat. If the share price goes down.
I like the name of wobbly end time.
I like the name of that algo, though.
Yeah.
TWAP with a wobbler.
But essentially, to beat it, the way the structures work is the broker has to guarantee to finish the program no earlier than 75 days after they start and no later than, say, 125 days after they start. I'm making these number of days up. And then the broker has latitude to finish at any point inside that 50-day window. So, obviously, if the share price is going down, they can speed up. If it rallies, they can slow down. And if it's below the average towards the end, they finish at the inside window. If it's above the average, they drag it out to the last day. And if you look at how these things work, that's exactly what happens. And if you think about that from a corporate's perspective, the alignment doesn't. No, it's completely wrong relative to what the corporate should be getting, which is more shares and all that sort of stuff. They just don't work.
It seems very gameable.
It's incredibly gameable, and you can look. So one of the things I look at, and actually one of the things which is very, very different, and it sort of comes to another part of the question you just asked me. What's very different in Europe and in the UK is the transparency laws we have with regards to daily trading activity require the corporate to publish as they progress, quite frequently as they progress. Like in the UK, it's T+1, trading day +1. So if you did a trade in your own shares today, tomorrow morning before the open, you've got to tell the market, yesterday I bought 100,000 shares at $52 or whatever it was, right? So that trade level detail, daily trade level detail, is really helpful because people like me and investors can look at the footprint from the trading activity, and from the footprint you can tell an awful lot. You can see, well, what style of execution is the broker using, how much value have they spent to date, and all those sorts of things. Whereas in the US, that's currently not true. And
right. Well, there is. Well, the SEC has within the last year, I think, taken action, and I know because I keep up with these things.
Former regulator. Here we go.
I used to be. I don't know if you know, Mike. I did have a senior.
Much like his shit Irish accent, this comes up in everyone.
Yeah.
Does your cup just have liquidity and handwritten? Did you make that?
It does.
Mike's drinking from a cup that says liquidity. That's classic.
It does.
You guys are too stingy to send me any beer, so I thought I had to.
We can't. There's laws. There are laws that prohibit us from sending.
We sent it. Your son's drank it off. Do you have son?
Okay. That's what it is.
That's very true.
They just wobbled by the door there. They're like, all right, Dad. That's classic. He made his own liquidity. I've never seen that before. Sorry, back to the former SEC guy. I don't know. You were about to jump in and say the SEC are doing something.
has recently adopted changes that require the reporting of daily activity in terms of buyback, but it's substantially delayed, as I understand it. I think it's like, sort of quarterly or biannually or something like that.
That's a really good delay. The delay, I think the design of the SEC's transparency laws are superb. The problem is the Chamber of Commerce, I think, are currently challenging them, and whatever you guys call your Fifth Circuit Court of Appeals. I don't understand how you're
the Fifth Circuit, exactly. Well, there's a lot of gamesmanship in terms of where you challenge these things to try to find
so it looks like they might not go through. But the delay is really smart, because if we think about all of the problems in share buybacks, there's a governance problem. The board needs to ask the right questions. The second component is there's a product problem. So we shouldn't allow the specific problem products to be sold. Particularly in the US, you've got a product called ASRs, or accelerated share repurchases. Mm-hmm. They're super terrible for corporates and share buybacks, but they're loved, I think, by some segments of the corporate market. But I wish I could help people understand why they're so bad. But then there's an issue around the disclosure rules. The ones in the UK, which I'm very glad the SEC don't have, but on T+1, you don't just tell the company, you don't just tell how many shares you bought. So you think about it, before you start, I'm going to buy £1 billion worth of my stock. You tell the whole market that. Then on trade day 2, you tell the market, yesterday I bought, £5 million worth of my stock at this price. So, and not only that, but you also have to give what we call time and sales in the industry. So you have to tell every single X lot. So I bought 300 shares on the LSE at 12. I bought 500 shares on Aquis at 15. Right?
Are you serious?
Like all the way down.
It sounds like the Chamber of Commerce would really hate that regime. I mean, if they thought what the SEC was doing was
that's nuts.
It's way too transparent. So if you're a trader or a market maker, and you want to know, well, what time, yesterday and the day before that, did the buyback start? You can see
them coming.
At 8:04, they start, and at 16:29, which is 1 minute before our closing auction, they finish. On an average, they buy this many shares and this or that. They buy it on these 3 venues, but they don't buy it on all the others. You can see everything. It's just fantastic transparency, but its timeliness is appalling. And it's very, very disruptive.
Interesting. Well, you touched on another aspect of equity market structure over here, which is why people, if they're big enough, they got enough money, they challenge any regulatory change they don't like in court, because I think they figure, why not? If you can get away with it and you don't really care about your relationship with your regulator. But anyway, I'm sorry, I don't mean to. I want to get on my soapbox.
Yeah. The issue with if the challenge is upheld in the US is you're never going to see in the US, the terrible destructive value and loss, the value loss to shareholders, because you can't, without the data, you can't analyze it.
It's just a black box.
The data in the US is lacking, but the data in the UK is great, but too soon.
It's way too soon. Yeah. It should be quarterly delay, I think, is perfect.
Fix this shit, John.
Well, it's not my job. It's not my job to fix it.
This is ridiculous. How do the public companies react when you tell them this? I mean this respectfully, but we were in the listings business. They didn't know a lot of this stuff. It's really interesting. I kind of put them into 2 camps. Yeah.
So camp 1 is the camp which actually feels it. Like when I go in and see them, it's like, Mike, we're happy to talk to you about how we think about our share buybacks, but we're super unsophisticated. We don't use any of this algorithm stuff. And we're all spreadsheet based, and we know we're miles behind. So it would be great. Maybe we can learn something from you, but we're very unsophisticated. So don't expect too much. So I get in and talk to them, and these guys do it absolutely 100% right. They have share price levels, which they care at. They buy it responsibly. They rotate through brokers. They take days off. They do exactly what you would expect. And very similar, actually, to how institutional investors would handle a thing. But they present very, very defensively, and so I ask lots of questions. Then I sort of say, "Do you mind if I make some comments?" And then I tell them why I think they're doing it right. And then I ask them, "Why, out of curiosity, don't you buy these packaged products from the brokers?" And they give me usually 1 or 2 answers. It's either we can't commit to the program in terms of it's a total lack of flexibility. If we want to be able to slow down our share buyback or stop it, or sometimes they fund it from cash flow anyway. So we just can't, we don't know. So it's either the flexibility issue, or it's it sounds a bit too good to be true. I don't really trust the guys who sell it to me. They don't explain it very well. And I typically don't buy things I don't understand. And then when I explain it to them and I go,
it was a good call.
They walk out of the room just going, oh, thank you so much. Like, you've really put me at ease, all this stuff. But from my perspective, I've got a consultancy business. Like, they're not a potential client of mine because they're doing it absolutely right, and they should keep on going. They shouldn't add another layer of cost just to be comfortable, right? They've got it bang on. So the other end of the sort of spectrum are a lot of corporates buy these products, right? Because they're sold very, very well. They sound fantastic from the way they're pitched. And obviously bankers are pretty good salespeople, right? So they do a good job. And then when I sort of listen and go, why? And some of these guys they really do understand the products well and understand how to limit all the optionality down by narrowing the window and all that sort of, they get it, trying to maximize the discount they get, all that sort of stuff. But then when I sort of explain it to them and sort of walk them through it and go, you do realize, and we go through the whole thing, and then I actually tell them, that you're actually selling your interim volatility at a discount, and the way that you model it all out, and Monte Carlo theory, all this sort of the detailed stuff that you've got to get into to try and help them understand it. They literally turn around and say, hey, Mike, you're the first person who's ever told me this. And then I sort of go, we sort of go through the process. And I've had one guy literally tell me, who else knows this? Like everybody who's in execution understands how this process is. The whole industry out there who know how to do that. He said, yeah, but who else knows this in this share buyback world? I'm like, I don't know. You said, well, you're the only guy who's ever mentioned it to me. I buy my products from, and they name all the ABC banks, right? So I'm good because I'm buying it from the IBM of the world, right? They can't sell me false products. I'm like, I don't know, but I can tell you.
They fucking can.
You're putting your board at risk. Let me just put it that way. And I'd love to be able to help. Shall we go and have a meeting with your broker? I'd love to be able, And they obviously shy away from that because they don't want to upset the apple cart. I get that. Or they just don't want to go and talk to their board because their board won't be happy when they find out. That's for sure.
Yeah.
What am I going to do?
Yeah.
You don't think they're not met with, I would imagine, not that I sit on the board of a public company right now, but I would give the investor relations person or whoever is responsible for that kudos if they came and they found a different way.
I come from your school. Yeah. And the interesting bit, this one chap who was really helpful to me to help me explain, he said, Mike, but you don't understand. One of the reasons I got hired into this company is because I had 10 years of share buyback experience. I actually got picked in part by the board to help because this company wanted to start doing share buyback. Well, I get it, but it's not your fault if you're buying a product from a trusted service provider that the product isn't appropriate. You're not meant to understand. Like, do you know who you're dealing with? Like, these products are priced off the derivative desks of large investment banks. And I personally don't think a CFO or a head of treasury is meant to understand how, derivatives desks price product. They're not meant to understand the sort of the volatility value within these types of products. They're not meant to understand how trading floors extract value from flow. Like, that's not their business. They're accountants.
Yeah.
Or corporate finance guys, right? So I don't think, well, I can't say for everyone, but certainly the people I've spoken to, I don't think they're just not equipped because they're experts in something else. But it's true too that the bankers I've met, like the bankers being the corporate advisors, they also don't understand how the trading floors extract value from flow. They don't get it. When I explain it to them, they go, oh, they're the first people to put their hands up and say, I know nothing about execution. I understand, finance. So,
well, then if the guy who's selling the product doesn't understand it, the guy who's buying it doesn't understand it, then you're really kind of screwed.
Yeah, but
that's why you need some candor.
That's why you need some candor. Exactly.
Yeah, that's where the name came from.
That's why you need, hence my name. Yeah, exactly.
Yeah.
But also the tax advisors. I spend a lot of time with the lawyers because the legal teams in the sort of like these huge, big, large legal firms. They spend a lot of time structuring the contract documents for doing these transactions, and they're also reasonably unique insofar as they're a trusted advisor to the executives and the board members. So when I explain it to that group of people, they go, because they're about the only group who are not conflicted.
So are there, I mean, back to your background, like electronic trading, right? And, you saw the electronification of a lot of these trading desks and how things went from cash traders to algos. Is there any correlation to this business where are there newer entrants coming out who will do this execution better and, tout AI and technology and all this other nonsense, right? That, it's the new fucking plastic, but like there's got to be something.
I followed that whole trick from being a cash trader to being a program trader to being the algo guy to being the server, all that sort of stuff. Yes, in short, the brokers who don't have derivative desks don't have any conflicts, all right, and they don't have their bankers don't have.
They're like the equivalent of the agency brokers versus full service. And okay.
Yeah. And there's tons of those people who do a really, really good job. The challenge is the larger the transaction gets. If you flip that around and you think about if you're the CFO in the deal team within a corporate, and you're sold a product which basically guarantees you outperformance to what you think is the industry benchmark, it's a great product from that perspective. It gives you a huge amount of comfort. Yep. Whereas if you go to an agency broker who sort of goes, well, the execution is kind of market dependent, and right, which one are you going to go to? The one which gives you a guarantee that you can say up to your board, yeah, hey, look, we're going to get not just the average price, we're going to always outperform the average price by at least 50 basis points or 20 basis points or 100, whatever that number is.
Check the box and everyone moves on.
You can never be wrong.
Right. Yeah. Well, it reminds me of the old saying, that I always used to hear back in the day.
This should be good.
And you'll appreciate this, having come from Goldman too. That saying was that one of the reasons that Goldman always stayed number one in terms of investment banking rankings is no CFO was ever going to get fired for picking Goldman to do the job, right? I mean, if you pick somebody else, and then you face much greater risks of being second guessed. But regardless.
Regardless.
This
is a great transition, John. See how he did that? This is a podcast pro, Mike.
Yeah.
But there's one other thing which I think is relevant to you guys is the fourth thing which I think we need to figure out as an industry is the way these structures work right now and the way the safe harbor rules are written. Shareholders can't sell into the corporate buyback in any of these what's called open market or OMR style transactions, or indeed ASRs either, right? So the way the structure works, the broker has to buy shares on exchange, whichever exchange that is. So the selling shareholder can't ever actually sell the shares, which the corporate wants to buy back from them, directly to them. It's kind of insane. So if you think about the right way to do these transactions, if you've got a very, very large transaction to do and you're a corporate and the share price is attractive to you, you should be able to buy blocks of stock through exchanges like IEX and not fall foul of any market abuse rules because it's within the confines of a regulated exchange and all that sort of stuff. Like, you should be able to do that. We should solve for that. That's good for shareholders, good for investors, good for corporates. That's what we should be solving for.
Well, we're for anything that brings more orders to exchanges and IEX in particular.
As we talked about earlier in your intro, you've over 30 decades of experience in the industry. How did your roles at Goldman and Virtu prepare you for Candor? Like leaving big organizations within the industry to create something like Candor, which I guess, why do I keep calling it Candor? Candor. Do you meet with resistance from people you used to work with? Like, do people think you're selling out, doing something different?
Yeah, the background stuff has been in terms of it was 30 years, not 30 decades, by the way.
Did I say 30 decades? I almost said seconds.
I'm like 300 years old. I feel like that sometimes. What I find really exciting in the sort of the Candor journey is just that it's I'm sure you've probably figured this out as well. When you found something, you really do put yourself out on a limb. Yeah. You learn a lot about things that you never thought you'd be doing, from talking to journalists directly. Like, I try to get awareness built and all those sorts of things. This is a problem that I never had to deal with myself before. But in terms of dealing with my sort of peers and previous peers, that's really interesting because when I explain why I'm doing it, and the sort of never really sort of spoke about the real reason why I sort of started down this journey, but it's really to try and help corporates bring down their cost of transacting. And the reason why that's important is because you probably remember this from when we introduced market competition in Europe in MiFID I. Yep. But if you can bring the cost of transacting down, you bring a whole new bunch of players to the market and you do wonderful things. And we took execution frictional costs down to about 20% of what they used to be there in the MiFID I process. If we can do that for corporates, when they issue shares and when they buy back shares, that changes, I think, a lot the sort of like the attractiveness of our public markets. At the moment, we're competing with private markets. Like all of us need, more, companies listing on public markets. Like, why do retail trade for free? Institutions trade for 10 bips or 5 bips or 3 bips, and corporates trade for 3% to 10% when they issue, and somewhere between 5 bips and 8.5% is what I've found for doing share buybacks. Like, that's terribly destructive to the capital. So when I explain that to my peers, they go, okay, that's really helpful, because everybody's worried about why did, in the UK, why did ARM list in New York, right? That was an issue for us, and we're all looking, what can we do? It's pretty simple. Like, one of the things we all have control over is we can bring that cost down. So I'm collaborating with a lot of firms. There's a small little firm called Squarebook, which is dealing with the other end of that problem, if you like, trying to help corporates to, list and issue shares. That side of the equation, there's lots of innovation in that world. If you think about the IPO side of the world, when was the last time there was any innovation in that or sort of new technology in that business? I genuinely think, I'm being a little bit facetious, but I think the last time there was proper innovation in that side of the world was when, the Eric Dobkins of the world and all those characters sort of introduced the syndication process of the underwriting risk and the green shoe and all that stuff.
Jesus.
The green shoe. Yeah, I know about the green shoe.
Did you issue that, John?
No, I did not. We're talking over decades, many decades ago.
30 decades, like Mike?
Yeah, probably, many decades.
like 30 decades,
green
I think
shoe. Green shoe.
Think that was the 1990s, 1980s, 1990s.
I want to say 80s, because I think green shoe comes from the name of a court case, I think, but it's basically, I know what you're talking about.
But just
it's a long time ago.
Technology has done and innovation has done to the rest of the trading markets, and everything. Like, you guys are talking in sort of millis, micros, nanos, and we're still talking about like there hasn't been a single proper innovation. So if you get modern auction theory and all that sort of stuff into the allocation process, and you can really change things up. We tried direct listings a while ago, but they seem to be very out of focus. You could argue that's an innovation. Mm-hmm. But I think there's a lot of space and a lot of goodness we could, if we could allow competition in there, there's a lot of good things that could happen, which would really.
And then you had all like blank, sort of spade of blank check companies that generally didn't turn out too well. So it's Well,
we got to ask our question at the end. If the Wall Street bull came to life and could talk, what words of wisdom or advice do you think it would share? Is this the first time you've heard this question?
From his expression, it would seem so.
Yeah.
I guess it would sort of depend on where the bull comes from, wouldn't it? Because
let's put the bull in Canary Wharf.
So if the bull was from Cork in Ireland, I think it'd be quite a genial, pleasant chap, right?
Mm-hmm.
Yeah. He'd probably lean over and whisper and say, "Ira, you should be careful around here, boy." And suggest
a good Irish accent.
Maybe you should move out of the way. This is since this is the podcast of terrible accents. But if Bull was sort of like a 1970s New York taxi driver, as portrayed in sort of Hollywood movies, presumably it would be like, "Hey, get the fuck out of here!"
Very good.
There you go.
Trying to be a bit more blunt, but I don't know. No idea. I can't imagine the bull would say anything particularly wise, but who knows?
Very good. Well, it's as good an answer as any.
So we're going to give this man some socks or what?
You're going to get some socks for that. They probably cost us triple the cost of the socks to send them over to England.
Probably. That's probably right. But it'll be well worth it. Well worth it.
We appreciate you joining us on this podcast. From one founder to another, I know it's a difficult thing and it's a brave step to take. And we wish you the best. And
yeah, it's been a pleasure.
Well, thank you very much for inviting me. I look forward to listening to more of your podcasts. They're amazing.
He's shaking his head no as he said that. Thanks, Mike.
Over and out.
Over and out. No. Are you a diehard boxer or airliner, or just a fair weather fan? No judgments, I know how annoying JR's Irish accent can be. Either way, we want to hear from you on our new Boxes and Lines listener survey to find out what you think about the show, give input on future episodes, guests, and more. We'll take it back to our survey counter thingy machine and consider all of your inputs as we plan our 2024 season. You can find the survey at iex.getfeedback.com/boxesandlines. And don't worry, there's something in it for you. That's my drum roll. JR could probably do it better. You get a pair of socks. That's right, take the survey, we'll send you a pair of our coveted Box and Line socks while supplies last in a new limited edition print. How's that for listener appreciation? So take the survey, tell us what you think, and thanks for listening. Again, that's iex.getfeedback.com/boxesandlines. Over and out.
Boxes and Lines is a podcast from IEX Exchange. It is hosted by Ronan Ryan and John Ramsey. Executive produced by Daisy Clace, with support from Benstown. For more information and to hear more episodes, go to iexexchange.io/podcast. Thank you for listening to Boxes and Lines. The information and opinions expressed in this podcast are provided for informational and educational purposes only, and IEX Group Incorporated and its affiliates do not make any representations or warranties as to the accuracy or completeness of the information contained in this podcast. Nothing in this podcast constitutes a solicitation or offer to buy or sell any securities or provide any investment advice or service. Some portions of the preceding conversation may have been edited for length or clarity. Copyright IEX Group Incorporated, all rights reserved.